Hey guys, it's Will. So most investors, they chase profits on a chart and they can't seem to figure out how to keep the profits. Today, I'm going to give you the only 3 steps that actually make you more profitable more consistently. And step 1, you'll probably find that this is going to rewire how you look at stocks, and that is looking at the markets versus the profits. So number 1, you're looking at the profits as kind of a scoreboard. You want to see they have profits, that they're growing, or that they have revenue. And then the market is also a key there in identifying in step 1 whether you're looking at the profits or you're looking at that just addressable market. That's going to differentiate between you being someone that's looking at their real customers versus just the slides that the company puts out on the total addressable market. So for example, you want to see shipments, you want to see deployments, you want to see integrations or new contracts for that company, and you want to see that they're having more of a capacity problem where they're trying to increase their capacity, um, and something that's showing signs of their unique delivery is giving them this value curve where they're growing. They have renewals, not just one-time customers, but they're getting renewals, and that their profits look sustainable. Now, the usage side of the market is really important. So, like, you want to look for revenue, you want to look for profits, but you also want to look for the quantity of the usage. This is the difference between just buying a company because everybody's talking about it and the market's growing versus seeing that they're getting real world demand for the product. Now, step number 2 is realizing that holding assets and focusing on the asset side versus just short-term trades is really important. Productive assets in the long term are going to compound for you and do the heavy lifting, and trading is the tactic that you use around that core. It's never the identity, it's just you trade, you look for these short-term gains. It works to an extent, but the core conviction that you want to have is around a company that has real usage and isn't just noise. And so I usually go, 70% or so of my investment is long term, and about 30%, is more for the research, maybe even the options, those small bets, hopefully asymmetric bets with predetermined risk, and I know where I'm going to buy and where I'm going to sell. And if you ever want to know the shorter term, some of you guys buy long term and you hold on to assets. If you want to know the shorter term side of things, like how to pre-write your exits, eliminate the emotions, your sell size, not just a thesis, but the trimming, like when you're when you're positioning yourself in a position, what is the percentage for profit versus reward? The first link in the description is a free trade profit calculator. Now, number 3 is using the right tools. You want to use the right tools when investing, whether that means, compressing the research, using AI, or killing some of the guesswork around, for example, that trade profit calculator really helps you. The idea is to not be stuck in paralysis and always be analyzing a stock. The idea is to have the ability to get quick fundamentals, quick idea of the cash flows, look at the market that they're in, and then have a clear idea of what the sizing should look like in your investment into the company, or how you're going to allocate, how much you're going to allocate in a quick amount of time. So what works good for this? Well, that's exactly why I built a tool called Mercatus. Mercatus is a tool that essentially is AI driven screening. So if I show you kind of how it works, this is kind of the idea. I could search a company right now like NVDA here, and I can get an analysis from ChatGPT. And these tools allow me to get, the future charts, the analysis. It's looking at all the press releases. It's looking at the charts for me. It's looking at the financials. It's tying that relativity to the future. And I can also even use Grok. If I wanted to swap here between Grok, I can get Grok. So we got different AI models. But ultimately, if you're trying to eliminate some of the guessing and get not just the future outlooks, but ultimately also analysis, using AI tools is helpful. You don't necessarily need to use this tool. This is our tool that we use. You can see NVIDIA here is growing in AI and data center markets, and it's likely to drive growth. So we know where it's going over the next 3 months potentially here. And of course, this is for educational and research purposes. Not always is 100% correct, but it says like the reasons why. They have their data center growth, They have some more R&D. They got some sector dynamics, maybe expanding into quantum computing. These are things we look at that allows us to see kind of the reasoning why we're seeing a company go up, and also visualize, some other things like we recently added the financials. So these are just kind of tools in one place. Now, if you wanted to, you could go and, go to a ChatGPT and search it on your own, or you could go to the news, for example. Let's say we're doing NVIDIA or AMD. I might go to the news articles. I could search it here on Google. I might go to Google Finance to pull up this income statement that I had. Or I might look at all the articles or the news articles. But ultimately, that's great. But using AI that can help you to, streamline that process is always helpful. So if you're curious about the machine, you want to know more about it, I'll leave it in the third link down below. Now, when it comes to building out your strategies and growing as an investor and growing your portfolio, ultimately, it's going to come down to identifying companies that are leading the industry or becoming prominent players in an already large industry. A good example would be that we saw Rocket Lab start to come up from a really young age, and seeing them at $3 a share to now $50 a share. We're able to do that recognition because we could see SpaceX. They're a $250 billion company, and they're in similar markets. And Rocket Lab at the time was just a couple $1 billion. Now they're, I don't know, 20 billion or more, or something like that. You could look at the same thing with data centers or AI companies. Look at the big players and then look at the smaller players that are coming up and say, where could this be if they really continue to grow and they continue to thrive? Could their market cap be, half that or a quarter of that of the big company? And if that's the case, they could be in that position. Then you're looking at a potentially good opportunity. Now, differentiating between the long-term holds and the short-term holds is not just good for you to be able to continue to build your position and invest profitably over the long term, but also for you to be able to catch some of those dips, be able to trade, and maybe have a small allocation of your portfolio for those higher leverage opportunities. When that stock pulls back, it looks like a good deal. Maybe you add for the long term, but you also find that opportunity for that short-term trade to capitalize on the value discrepancy. And that's what we love to do. We love to look at the technicals. That's where you can look at the fundamentals, the news, the charts, and everything that goes into trading the RSI, the MACD. And if you ever want to learn more about that, make sure to subscribe as we cover those on the channel in depth. And I also trade live every morning at Market Open. If you want to join us, it's the second link in the description for Stockmate down below. Thanks so much for joining. I appreciate you all. I hope you have a great rest of your day, and I'll see you in the next video. Take care.